All right, welcome back everybody. We're ready to get started with the last panel of the day. And last but not least, we are going to be talking about digital assets custody. Really impressive panel here. Moderating will be Elad Roisman from Cravath, Swaine. And we have Chris Cox with Citi, Lesley Chavkin with Paxos, Connor Mykins with Phantom, Christos, I'm not going to try your last name, with the Bermuda Monetary Authority, and then Michael Shaulov with Fireblocks. Great panel. Elad, I'll let you take it away.
Thank you so much, Dan. What an incredible way to end today on the protocol room. I think, I'm biased, but I think we saved the best for last. And as the sort of discussion of what this panel is going to talk about, I feel like it's almost like a movie trailer. It says, from institutional trust to technical resilience, the conversation dives into what custody must become in a world where code is the asset. That's pretty impressive. Why don't we start with you, Chris? Last month, you co-authored an article by Citi on the future of post-trade, custody and settlement in an always-on world, which indicated that clients are turning to their customers for increasingly sophisticated and a wider breadth of services, transforming the role from safekeeping assets to serving as enablers to their clients. Businesses as they take on functions such as valuation services, performance measure and risk, and more of the middle office. Could you expand upon the key demands you are seeing from institutional clients from a digital asset custody perspective, and where do you see the demand going in the future?
Sure, and thank you for the question. Look, firstly, the report is available on Citi Institute, so if anybody wants to download it, it's publicly available. It's a survey of over 537 participants in the securities market, and it asks them a variety of questions. In the context of digital assets, a few call-outs. Firstly, it was one of the most popular topics to which people responded this year. Secondly, it demonstrated the biggest year-on-year delta, which I find interesting even over and above topics like AI. And when you start putting numbers on it, people are talking about anticipating 10% of their securities flow being in the form of either digital or tokenized assets by 2030. And when you think about forms of digital money, that number increases to around 25% by 2030. And this geography, North America, was where we got the strongest response. So that's the survey. In terms of where our clients are, I think there are a few things that are happening that are important to pull together. Number one, the technology is maturing and people are becoming more familiar with it. Secondly, we're seeing regulatory clarity, particularly the Genius Act and other forms of legislation in different jurisdictions. And then the other thing is you're beginning to see networks and consortia emerge, and it's the industry coming together and asking itself the question of how does this technology really add value to clients. So what are we seeing from institutional clients? Well, we're definitely seeing them leaning in, and you can see that across a number of different dimensions. I think the emergence of crypto ETPs, I think IBIT I was looking today is about 645 billion now. That's pretty good. You're seeing tokenized securities in different forms emerging, digitally native, bonds and other instruments, and you're beginning to see that the industry efforts are beginning to move out of the lab and proof of concepts into production-ready environments. So we're beginning to get production-grade solutions put out there. What does it mean for a firm like Citi? We're interested in serving clients on a multi-product basis in every jurisdiction across the asset classes that we're in. So it's about offering a seamless continuum between the fiat world and the digital asset world. And the experience, I think, from the digital asset world has raised the bar. So everything we're trying to do, particularly in services, is about trying to give clients a 24/7, real-time, transparent, always-on experience. So we're leaning into digital asset technology. We already deploy it in Citi Token Services. We have the Citi Integrated Digital Asset Platform on which we're building institutional solutions, and we will deploy those to clients as they come to market. more recently, and specifically in the context of this conversation, and Michael and I were talking about this before we started, in custody, we recently completed an in-house built digital asset custody proof of concept, and that we expect that technology to form the foundation of a solution we will bring to market in the first half of 2026. So in short, we're doing a lot, clients are interested, and it's a very exciting space right now.
Yeah, we'll talk a little bit later about sort of the traditional finance players and the interactions with the digital native, but I think it's incredible to see where Citi is today. And I think you touched upon an important issue, important thing for all of us, which is there is certainly a lot more regulatory clarity and I think acceptance over the last 6 to 9 months than there had been in the past. Speaking of that, Lesley, the SEC staff of the Division of Investment Management issued a no-action letter last month, roughly 2 weeks ago, stating that it wouldn't recommend, subject to conditions, which there always are, an enforcement action. They wouldn't recommend an enforcement action against registered advisors or regulated funds for treating certain state-chartered trust companies as banks with respect to the placement and maintenance of crypto assets and related cash and cash equivalents. Given Paxos' role as a New York State chartered trust company regulated by the NYDFS, could you please talk about some of the potential practical implications of this relief? And if it'd be possible, give us a little insight into the current role of state chartered trust companies with respect to digital asset custody.
Okay, it's on. Great. Thanks so much. And I should make a disclaimer first. So Paxos is a state to an OCC. That's now laid out as the federal option for non-bank stablecoin issuers, so it made a lot of sense to have that nationwide authority. That said, even when our application is approved, we'll remain champions of state chartered trusts. I think this is where a lot of the innovation in this space has happened, so I just want to make that clear. But to your question, I think the no action letter is huge. It's a pivotal moment, I think, for institutional adoption of digital assets, because funds, RIAs were sort of in this catch-22 until recently. So they had to use a qualified custodian, primarily banks, but you had banks that, whether they were reluctant to or unable to, were not interested in custody because of regulatory hurdles, because they had legacy infrastructure, or burdensome accounting principles like SAB 121, so it was cost prohibitive. So there were a lot of reasons banks weren't in the crypto custody space. And in the background, you had these state chartered trust companies that were prudentially regulated. They had this infrastructure that was purpose-built for crypto, and they were building up their own client base, but there was this gray area around RIAs. Now you have this no action letter. I think it's huge, and I think that unlocks asset managers, hedge funds, pension funds, family offices, and now they can use these specialized crypto native custodians. And the question that I've seen pop up is, well, why are these state trusts well suited for this, right? There's been some criticism. And I think for a few reasons. One, the institutions are prudentially regulated, right? By regulators like New York DFS, which is very robust. We have governance standards we have to follow, capital requirements, cybersecurity protocols. So it's not bank light, it is bank like. We also have a totally different business model as trusts. We are not in the business of taking deposits or making loans, so there is that stability there because you are not engaged in rehypothecation or credit transformation. And then finally, I think it's because this is an industry that has sprung up from crypto. It again has that purpose-built infrastructure, different than a bank that may be having to kind of rework legacy infrastructure and try to fit it into today. And so in terms of practical implications, I think what we'll see is we'll see more crypto-focused funds. I think we'll see digital assets in traditional portfolios, and that's all coming into crypto-specific custodians. And I think it also, this has been a good validation of the state frameworks like what New York has in place. I think that no action letter was an important acknowledgement that this is the right model to use, that it's safe. And then finally, I think there's going to be this interesting competition. First, you'll have states competing. There are more that want to pop up in this space and put frameworks in. And then for the banks, they're at this moment where they're asking themselves, well, do we want to cede this all to these new entrants, or do we want to step into this space? And so I think there's some opportunities for partnerships, for acquisition. So it's a very interesting time.
Yeah, I totally agree. And I think, my personal view is, one federal regulator is not the solution for all problems. And I think your competition point is great, and especially since this is, in many cases, people who have greater familiarity with this space than some of the federal regulators. So I think that's incredible, and you see this, I think, more and more from the current regulators. They're willing to sort of take that into account and enable sort of the growth of this asset class. Speaking of great regulators, Christos. Bermuda was one of the first jurisdictions to begin passing digital asset regulations, going as far back as 2018, which has evolved over the years to include aspects such as sandbox licenses and a digital asset custody code of practice. Based on these experiences, particularly in relation to the evolution of custody models, what trends or developments are you seeing from an international or cross-jurisdictional perspective?
Thank you for that question. So yes, in Bermuda, we do have the Digital Asset Business Act since 2018. So we have approximately, it's not 7 years, because between starting to implementing and processing license, I'm going to say 6 years of supervisory experience. Today, we have over 20 custodial wallet providers that are licensed. And the reason that I'm mentioning it is because we are seeing different shapes and forms when it comes to custodial wallet providers. We're seeing entities leveraging their own proprietary technology. We are seeing entities outsourcing custody to a third-party custodian, which entity has the keys. We are seeing entities that they use wallet as a service and they provide custody. So we're seeing different shapes and forms. When it comes to the evolution of the role, what I would say is that one thing that we are observing is the evolution from, and when I compare it to TradFi, right, it's from a more of a passive safekeeper to more of an active fiduciary, if I were to say. We are seeing the realms converging, so we are seeing a lot of more responsibilities actually being for custodians. When it comes to multi-chain, multi-asset management, they do staking. Some things that we are seeing is more delegated staking. So one of the questions that we're going to be asking is the selection criteria of vendors. How do you select? When it comes to slashing risk, how is this being managed? When it comes to tokenization, there are other stakeholders in the ecosystem, meaning that you have the oracles as well, and then it's the responsibility of the custodian to keep track, to act as the intermediary layer in keeping track of what is happening in the on-chain and the off-chain world. So we are seeing this kind of evolution. What I will say is that even though the role is evolving, even though you're seeing the technology progressing, I don't know if you have seen the IOSCO and FSB recommendations from 2023, and just yesterday they published the final reports after a thematic review that they have done. If you have not done so, I strongly encourage you to read them. They are very, very good. Especially what they advocate is functional equivalence, meaning that, yes, the technology is changing, their role is evolving, their role is a bit different in today's world. However, the same principles at a high level apply. IOSCO, actually, 5 out of the 18 recommendations, they have to do with custody. So when it comes to governance, when it comes to safekeeping, when it comes to reconciliations, when it comes to bankruptcy remote, they are the same at a high level. So these things, some things are not changing, but it's how the technology can be used to actually achieve the same result in a different way. And another vertical that I would like to focus on is on the global and the borderless nature, or when we're talking about digital asset custody. This is quite important because when it comes to legal classification, regulatory classification, we are seeing divergences. We're not there yet when it comes to international collaboration, coordination, and harmonization. This is another point that is strongly emphasized and echoed in both the recommendations and in the thematic review. This is one that we are very supportive. As a matter of fact, we also commend the US legislator because under the Genius Act, there is a reciprocity regime which is also found in the Clarity Bill. It's definitely the right approach. This is the only way that we can avoid potential arbitrage between jurisdictions. It's the only way forward. And Bermuda, it's definitely supportive of this approach, especially in view of the reciprocal status it already enjoys in the insurance sector with both the US and the EU. So.
That's great. That's great. And I think, as we mentioned, Bermuda has been sort of leading the charge. I hope regulators in the US sort of take some of this back, including the concept of sandboxes. But I think one of the things you sort of talked about, the collaboration across countries, and especially through IOSCO and other places, it all stems from this idea is how can you come up with a framework where people can trust the various regulatory bodies to have consistent standards. And that sort of ties into our next question for Michael and Connor. There's been a noticeable increase in activity in the DeFi self-custodial digital asset wallets, which often rely on novel and varying mechanisms, including multi-party computations and smart contract wallets. As providers of digital asset wallet services, how do you think about the balance between innovation and custody models and the need for consistent, enforceable standards that regulators and institutions can trust? And we'll start with Michael.
Yeah. So I think that the concept, I would argue that actually like multi-party computation or MPC and to a certain extent also smart wallets are not as anymore, unfortunately, innovative. For those who are not familiar with Fireblocks, we provide infrastructure for the vast majority of the institutional space. So whether those are like banks like Bank of New York Mellon, Cross River, fintechs like Revolut, Robinhood, and so on, and remitters and hedge funds, and so about 2,600 clients. Now, back in 2018, we actually came out with the concept of multi-party computation that essentially the basic function of what we call custody of digital assets is essentially the safekeeping of a private key. And one of the core concepts over there, which is actually a pretty straightforward concept in cybersecurity, is the fact that you don't have a single point of failure or a single point of compromise. And there are mostly like, two approaches to do that. One is MPC or threshold signatures or multisig, and they can be achieved through, again, either cryptography measures like MPC or measures like smart wallets, which create the multisig. Long story short, I think today, by the way, in 2025, I'm pretty sure that like every custody solution is mostly built on top of one of those technologies at the minimum. Sometimes there are cold storage solutions that would use an HSM, but they're becoming less and less common. And then I think that there is a question of standardization, right? So, what we've been working for, so we've been in this space for about 7 years. Right now, across all of our clients, there are over $100 billion of assets, so it's a lot. And this year, $5 trillion of transaction volume. So what we are trying to do is really create standardization and especially work with the regulators to elevate the standards that they currently have, right? So I do agree that there are frameworks that are being taken from the, let's call it, traditional financial space. If you're New York DFS regulated, and you have Part 500. If you are OCC, they have their framework that is basically derived from NIST, and maybe like the most advanced framework actually exists right now in Europe, which is DORA. But they kind of basically mixing and matching between how custody is being, or how cybersecurity, custody, operation resilience, and all that stuff are being done in the traditional space. And they're trying to basically argue sometimes that the same stuff need to be done for digital. The reality, and I think this is what we've learned over the last couple of years, and talking about all the hacks and everything that you read in the news, is that unfortunately it's insufficient. why it is insufficient. You can call it DeFi, but basically digital assets, they have two unique properties that you actually don't have in traditional finance. One is that settlement is instantaneous and there is no recourse, right? So basically you can't do fraud detection in the sense of like, okay, the transaction occurs, now I'll like, figure out what happens, what's going on. If I suspect that there is something problematic, I will freeze that transaction. Maybe I will roll back that transaction in the matter of a few hours. The second that you send the transaction on chain, it's gone, right? So that's issue number one. The second issue is not maybe completely unique to digital assets, but you have nation-state actors like North Korea, basically Lazarus Group, that although in the previous decade there were generally speaking going after financial institutions, the most known hack is the SWIFT compromise back in 2016. But over the last several years, they were primarily focused on going after crypto, right? And that makes it like, very unique in terms of complexity and attack surface, which clearly requires regulators to come in and mandate and dictate that the standards that custodial, non-custodial, basically any form of wallet safekeeping should adhere to certain standards, should adhere to certain investment from a cybersecurity operation and resiliency. And we've been actually doing a lot of work in terms of advocating that for the regulators that I think is now, we've seen this across European and other jurisdictions that this is being adopted. And we hope that now, as the regulatory changes happening in the United States, that the US regulators will be fairly quick in terms of adopting those standards and making sure that everything that is kind of built here in the US, and I think that a lot is going to be built in the US in the next 12, 24 months, is already basically taking into consideration all the unfortunate lessons, right, that we've learned in the last several years.
That's great, and I think, Connor, same question to you. How do we sort of not stifle innovation, enable sort of the good work that's been done, but providing sort of clear, consistent standards that will provide trust and surety for institutional clients and regulators?
Yeah, so no, it's a great question. So Phantom, we focus primarily on consumer or user-based wallets, and so a lot of our focus is creating a safe environment for consumers and users to onboard into the digital asset environment. And so to your first issue of the fraud prevention models, right? So transactions are final, right? There's really not much you can do once a transaction is sent. However, there are points of friction that can be put in place before that happens, right? There's a lot of open source data, a lot of like on-chain sleuths that essentially can flag this is a known scammer. Like you can put points of friction, right? So I think from my perspective, it's really important to not be too prescriptive on the technology used. It should be more focused on making sure that a safe environment is created for users. So whether it's disclaimer related, creating warnings before actually like executing a transaction, in a non-custodial environment, people can always export their keys though, right? So we can create points of friction, but at some point in time, a user can just export their keys and go to a different wallet. But at the end of the day, it really should just be disclaimer, risk warnings for users, and more of really education is really what it comes down to.
Maybe just to add to that, one additional thing that is not currently in production in any meaningful way, but it's likely that in the next 24 months we'll see some advancements in what we call on-chain identity, which is basically, it's called like some identity and compliance layer that will be attached to every wallet, and then I think some of those pre-checks, right, will be much more robust and much more stronger, where we will actually know where the transaction is going.
Right. I think the topic of just making sure that it's flexible, you're not stuck in sort of regulatory cement, and adequate disclosure, I think that sort of addresses many of the issues that we're sort of seeing today in terms of confusion and understanding.
Yeah, and just one other thing it'd be really good to add, related to smart wallets. I think it's a really, really fascinating technology. There's a lot of things that can be done putting into place, like spending limits on specific apps, right? So all that stuff can be built into an app. And so that type of technology, I think, is here and it's coming. So I think there's a lot of consumer protection things that are already happening without intervention. So it's just really just focusing on risk warnings, flagging, and just education for users.
Let's go back to you, Chris. So large institutions like Citi are able to offer scale, capital, and operational efficiency, whereas digital natives bring emerging technology expertise. As the digital asset ecosystem continues to evolve and the role of the custodian expands, do you foresee the relationship between traditional finance and digitally native firms being one of collaboration, symbiosis, partnerships, or more of a competition?
Look, I think the answer to that is all of those things, right? And probably none of those things. It's not really one or the other. And frankly, it's something we've seen before, right? So go back to the earlier point. Firstly, innovation makes us all better, right? We deliver better solutions to clients, and that's a great thing. But we've seen it in mobile banking, we've seen it in virtual credit cards, we've seen it in APIs, we've seen it in electronic market making. Technology is definitely advancing the delivery of financial services and how we do that more frictionlessly for clients. And this is another continuation of that evolution. Let me illustrate that with a very simple point. Citi has a direct custody business. We do it in 63 countries. We have something like a 25% share of that business. Most of our clients are banks. Right? So they are both our clients and our competitors. So, I think it's a situation we're familiar with and very comfortable with. And then the other point that I do want to draw out is that we have a global multinational client base, and they do business the way they want to do it, and some of that is bound by the infrastructure that they use, and that is going to have an influence on the way forwards. Typically, when you get into a large corporate, they have a system called an enterprise resource platform, an ERP, and that drives a lot of their processes. And that technology is still typically end of day, typically runs on batches. So Instant Atomic definitely has some benefits for them, but the pace at which many of these folks can adopt this technology will actually be driven, number one, by their desire to do it, and then secondly, just their capacity to practically get there. So if you go back to that survey, why is 10% of market turnover digital or tokenized by 2030, I think it speaks to that. In services, we're going to spend about $1.5 billion this year, and we have been for the last 3 years, modernizing and simplifying our technology. So, I think there were some statements about integration into existing stack and dealing with legacy stacks. I think we're investing heavily to make sure, and I alluded to it before, that we can deliver to clients where they want to do business, the services that they want in a completely integrated manner, whether that is fiat or digital asset. And that's something we're going to try and do. As recently as a few weeks ago, we turned on an enhancement to our technology here in the United States, and from a asset servicing and custodial perspective, that really moves things up to as close to real time as we think anybody in the market can currently achieve. Christos also alluded to something. Remember, the world's not equal. It's not moving at the same pace. Here in North America, I think the focus is really on crypto and stable coins. In Europe, it's more MiCA and tokenization. And then we talked about sandboxes in certain jurisdictions, and that's more the Asia model. So whilst innovation is a really tremendous thing, right, it can lead to fragmentation, more choices, more providers. And if you're clients, that's more choices and potentially more risk. So I think it very much depends, the competition point, who you're serving. And for Citi, our goal and our investment is to offer that as consistently as we can globally and allow clients to access all of these products and services at the speed that they want to, as frictionlessly, seamlessly as possible, with the minimum amount of change. Right? Most of our clients are complicated, multinational, and they actually want simplicity and transparency. And then just to pick up on the point Lesley made, obviously we're seeing new client segments emerge, right? Digital asset natives, and that's exciting. That means the wallet in the industry grows. And as a firm, we're excited about servicing those clients, supporting them, right? We will invest in them, we will partner with them, we will co-create with them where there is an opportunity that produces a client benefit and it's accretive to the Citi shareholder. So to go back to answer your question, I think it's all of the above.
Certainly sounds like all of the above. And I think to the point you were making is it's not binary, but it's important to have both the institutional, the retail, and everyone else tell their service provider what they're looking for, and that will lead to sort of the evolution that will suit every sort of fragment or part of the market. Coming back to you, Lesley, we talked a little bit about the programmable code being the asset. From a policy perspective, how do you think regulators should think about custody in a world where the programmable code is actually the asset?
So I think this is a very sort of foundational tension between this traditional custody framework and the really novel attributes of blockchain and digital assets, the things that give it a lot of utility. So just at a very high level, if you think of a traditional custody framework, it's all about bearer instruments and ledger entries, right? You think of stock certificates in a vault or gold bars in a depository, and the job of a custodian is pretty straightforward, right? You are making sure those assets are safe and secure from loss and theft. And then you go into the digital asset space, and for a concrete example, let's say I custody Bitcoin. Bitcoin's on a distributed ledger. What I custody are the private keys, right? And what I'm protecting is access and ability to transact with those. And I think going back to that framework, that original custody framework is really built around exclusive control. But with digital assets, there's not necessarily exclusive control. You have programmable control. You have shared control. So then it opens up questions about, well, who is the custodian? What is the custodian? And so I think that is what is challenging the framework that we have now. And in terms of kind of thinking forward about whether you can have safe custody, a definition of safe custody that is technologically neutral, I think this kind of gets at what Connor was saying before. If you're a policymaker, you really have to be outcomes and principles based, right? So if I'm a policymaker, the questions that I probably want to be asking are, who has the ability to make transactions? What does multi-party approval look like? What are the mechanisms? What are the policies in place for any kind of incident reporting? So there's all kinds of questions that you can lay out that are just neutral to whatever the technology is used for custody. So I think that's the way it's going, but it is quite a paradigm shift.
Right, and I think that I think we've all heard this many times, which is just focus on the principles. If you don't, sort of what you have is you have legacy laws and rules that sort of create almost unmovable pillars as technology, as markets sort of evolve. So I really think that's a great point, where if we can focus on what we think should be the means to achieve that end and have the ends in mind, those are usually the hallmarks of a good regulation or a good law. Michael, you talked a little bit about atomic settlement, and we'll talk a little bit now about stablecoins. So they sit at the intersection of custody and payments. How do you think about building custody models that protect users and institutions while still enabling seamless programmability and liquidity across chains? And then with respect to atomic settlement, there's obviously, you mentioned this, an inherent tension between being able to transfer something immediately, but having it be irrevocable. And do you foresee a future where stablecoin issuers may deviate from settlement finality to enable sort of reversible transactions?
Oh, okay. That's a lot of good questions, to be honest.
Yep.
Yeah.
Choose one you want to start, and I'll come back to the other.
Yeah. So we do. I mean, yeah. We kind of an anecdote. We did when we started Fireblocks. I think we didn't fully understood that. Maybe 7 years ago that stablecoins will be kind of the front and center, but actually the infrastructure we built from the get-go was kind of with the vision that it has to be a transactional custody or wallet infrastructure, right, for institutions, which eventually kind of set us up for being very successful with underpinning most of the stablecoin activity. Right now, about 10% of all the USDT and USDC is going through Fireblocks, and most of the remitters and payment companies are doing it, including like stablecoin issuance, the stablecoin issuers. With regards to the few questions that we have, maybe I'll start from the end. Would we see revocability built into the stablecoin protocols? I think maybe. I think, Connor, you can highlight that there is this, I would say, overlap between what do you put into the smart contract that governs the custody, what do you put inside of the smart contract that basically represents the asset, and there is also the intersection between them. And even right now, we're actually starting to see models where being deployed into the stablecoins, which allow programmability around the revocation of transactions. To be fair, in the context of, let's call it like anti-money laundering, if you look at both the Tether USDT and Circle USDC, they're already able to recall, revoke, burn those assets, right? So in essence, it's kind of already there. It's not very well standardized, right, from what exactly like each issuer is doing, but it is there. The other question is really what are we going to see with regards to, I would say, stablecoin adoption and how does it all work with custody? So our view is that every business and every market function is likely to move into some form of blockchain-based money, right? I think that stablecoins definitely are going to be a big part of it. There is a question around the tokenized deposits that I think are in the early stages of development, and then there is the CB, the word that is not allowed to be said in the United States, but it is actually quite popular in the views of the European regulators and in some areas in Asia. I think that although each one of them carries like a fairly different market or counterparty risk, the mechanisms, right, in which you actually safekeep and you transact are quite similar, and therefore the requirements from the wallets is really to build an infrastructure, and we're seeing it right now. There is a difference between basically custodying Bitcoin for a long-term investment, right? So, like, if you have a Bitcoin ETF, like, the BlackRock ETF and some of those structures, okay, you put it in a cold storage, it sits over there, it's all fine and good, right? When you work with remitters, on-ramps, and we work with, like, I don't know if some of the people here might be familiar with, like, MoonPay, Bridge, which is now Stripe, all those companies, they already at a scale that they are really touching the kind of theoretical capacities of the blockchains, and they're kind of pushing the envelope on the throughput. And then what you actually need to do, what we discovered is that what you need to do from a wallet or blockchain infrastructure standpoint is really create dedicated teams that are really focusing on working very closely with the protocols in order to be able to originate this throughput or that amount of transactions for each one of those protocols. It works different on Solana, it works different on Polygon, it works different on Ethereum. Like every one of them is just like a very different technological approach. And yeah, you kind of need to build that technological expertise to be able to do it. And I think that we are also, by the way, at the beginning of it, because if the likes of Stripe and Adyen will actually transfer the vast majority of their payment activity to be on stable coins, and if you kind of following the Stripe founders on Twitter, they're definitely very bullish and positive on doing that. We would need to be able to withstand something that, or the order of 20,000 transactions per second, which is now not something that anyone is able to do, and there is a lot of technological development that needs to occur to get there, but we are quite confident that we'll get there in the next 12, 24 months.
Fascinating. Before I move on to Christos, Connor, is there anything you want to add to that, or?
Not too much, because you did a really great job, Michael. So there were a point of discussion in some previous panels around agentic payments. How do you settle those if it's a fraudulent agentic payment? So I'm very curious to see how that progresses, and can you revoke, can you pull back those types of transactions? But I think that's a lot of TBD and where that'll land.
Christos. So supervisors are now asked to oversee custody that involves keys, code, and smart contracts, not just vaults and ledgers. From your supervisory vantage point, what safeguards or innovations are most critical to ensure that digital asset custody can be both safe and, we talked a little bit about this, future-proof?
So what I will say from an operator standpoint, from a custodian standpoint, I will repeat what I said before. If they have the functional equivalence, if they have the principles that IOSCO, FSB reiterate, if they have it as the Northern Star, I think it's the right way forward. But I would like to tweak a bit that question, and I'm going to be providing a bit the regulatory standpoint, because I do have that. I do believe that a regulator also have responsibility to ensure that is in a position to deal with this transformative period that we live in and this evolution of the custodians. A regulator needs to evolve alongside. And in order to do it, it's a three-dimensional approach. One, it's the regulatory framework, which I will have to echo a lot of Lesley's points, which I agree with. It needs to be outcomes-based. You need to be principles-based. However, you need to be cognizant at a legislative and regulatory framework that because of the capabilities of the technology, a lot of things could be handled in a different way. So it's a very interesting combination of technology agnostic and technology specific at the same time in relation to different considerations. The second dimension that I would say is resources. And when I'm saying resources, it's both human and technical. Human resources, definitely important. And I do not mean only a fintech team in the supervisory department. No matter how great a fintech team is, then you need to have a very capable policy department, and we do. You need to have a very competent enforcement department, and we do. You need to have a very competent AML department, conduct department. You need to have people, senior management when it comes to internal committees, and you're going to be recommending something. You need to have people in the room that they can understand the technology. They are not scared to get their feet wet, to really, really understand what is happening, really understand how the technology works and how the regulatory requirements are met, even if it is done in a bit of a different way. Technical resources, this is also non-negotiable. If you do not have RegTech solution, a SupTech solution, then just receiving only a financial audit, only financial information for 4 months after a year end, then the type of supervision that you're doing and the effectiveness of that supervision is potentially questionable. You need to see from an AML standpoint if there is some movement, some forensic analytics, sentiment analysis. You need to make a AI analysis to identify patterns. You need to have market abuse systems and controls to identify patterns. So all these things need to be in place. And the third dimension is the modus operandi. Again, I mentioned the financial statements. These are always going to be important to understand the prudential picture, the prudential image of an operator. However, at the same time, it's ex post facto. The more we move towards a real-time or close to real-time supervision, this is a regulator's dream. In Bermuda, we have launched an embedded supervision pilot. We are actually analyzing responses, we're analyzing findings, and we do hope next year to potentially continue some more policy work on the embedded supervision and how potentially a supervisory model could potentially evolve, transform to keep at pace with these interesting times that we live in and the models that we are seeing.
That's great. I think we have about a minute and a half, and I just want to give you guys this opportunity. Is there any sort of additional regulatory or legislative clarity that you think would really help expand the uptake of DeFi and the work that you guys do? Michael, why don't we start with you?
Yeah, I mean, I think that one of the questions right now that we're actually dealing with is how tokenized securities are going to interact with DeFi. As you can appreciate, the entire framework of how do you identify the investor, how the transfer agent works in this specific case is TBD, right? So that's like an open topic, which is basically kind of the next evolution, from our standpoint. And by the way, just as a side note, super excited about all the work that the SEC is currently doing on this.
Agreed. Connor?
Nothing in particular. Just looking forward to Genius implementation and then hopefully market structure. But
not so much legislative clarity, but I think for DeFi, one vulnerability that's come up a bit today is on cybersecurity. And I think that is an obstacle for wider adoption, institutional adoption. And I think there's a huge role that the US government can play, whether that's Commerce, NIST, Treasury, other agencies can play in sort of standard setting around cybersecurity. So, best practices around smart contracts, expectations around code audits, even just R&D around bug bounty programs and other kind of DeFi-related cybersecurity. I think that could have huge benefits for the industry, and you've seen the US do that for other industries, so I think we could take that model.
I think there are different questions. It's from a regulator standpoint. It's should DeFi be regulated? And if we see the TVL, potentially we're talking about some contagion risks. Potentially we see some at a later stage some systemic risks. So likely the answer is yes. Then the second question is, what does proper regulation? What does a proper framework look like? This is the million-dollar question. This is what we needed to see, because all legal constructs, all frameworks, they are developed on the fundamental premise that you need to have someone to hold accountable. So in the absence of a legal personality, in the absence of people, in the absence of the normal actors that you have there, what is the proper regulation? Then this is something that needs to be solved. So it's a different question. I think that I think I'm inclined towards yes. On the how, TBD.
And look, I think from our side, a lot of things have been covered, further detailing of things like the Genius Act, and then also a little bit more thought given to the capital treatment of assets on public blockchain. They're still quite heavy for banks to hold on their balance sheet.
Right. I think we also have heard in the past a margin, obviously. That'd be a big one as well. Well, I think that's it. Why don't we give our excellent panelists a round of applause.
All right, all. That concludes the programming for today. We have a happy hour, decentralized, first floor, second floor, and fifth floor, presented by our good friends at Citi. Thank you all.